There are more than 4,000 stocks you could buy today. A full-time analyst can seriously study maybe 30 of them in a year. So how does anyone actually find the good ones? Here's the secret nobody says out loud: they don't read first. They filter first. The best investors throw away 99% of the market before they read a single annual report. A stock screen is just a filter. You set the rules, the computer does the searching, and you get a short list in seconds. But here's the part most people get backwards: a bad screen buries you in junk, and a great screen hands you a list of companies you'll instinctively hate. Let me show you why. Most investors do this backwards. They hear a ticker, then go looking for reasons to buy it. That's not investing, that's a scavenger hunt for confirmation. Screening flips it. You start with every stock, then let hard numbers remove the ones that don't qualify. Think of it like hiring. You don't interview 4,000 people. You post the requirements, and the ones who don't meet them never reach your desk. And the beauty is speed. A screen that would have taken Benjamin Graham weeks of hand calculations in the 1940s now runs in under 15 seconds on a free website. So what should those rules actually be? That's where almost everyone goes wrong. Here's the most surprising number in this whole video. From 1988 to 2004, one simple two-filter screen returned about 30.8% per year. The market did around 12%. That screen is Joel Greenblatt's magic formula, and it uses just two numbers. Filter 1, return on capital. That answers, is this a good business? High return on capital means the company turns a little money into a lot. Filter 2, earnings yield. That answers, is it cheap? You want a good business at a fair price. Not a cheap business. Not a good business at any price. Both. Together. Most beginners screen only for cheap. Low price to earnings, low price to book, and nothing else. But cheap alone is a trap, because the cheapest stocks are usually cheap for a reason. Which brings me to the question I want you to answer in the comments. Which camp are you in? Do you screen for the cheapest stocks, or the highest quality? Drop a 1 or a 2 in the comments. I read them. Now here's what nobody tells you. The output of your screen is not a buy list. It's a list of questions. Remember what I said at the start: a great screen hands you companies you'll hate. That's a feature, not a bug. Think about it. If a stock is statistically cheap and high quality, the crowd is usually avoiding it for an emotional reason: a scary headline, a boring industry, a bad quarter. Graham proved this decades ago. His famous NetNet screen bought companies trading below their liquidation value. A study of that strategy from 1970 to 1983 found returns around 29% a year, versus about 11.5% for the market. But, and this matters, those NetNet stocks were ugly. Struggling businesses nobody wanted to talk about at a dinner party. The screen found value precisely because human emotion had pushed the price too low. So your job after the screen isn't to buy. It's to read. You check the balance sheet. You ask why it's cheap. You separate the temporarily hated from the permanently broken. The screen does the searching. You do the thinking. That division of labor is the entire game. Let me make this practical. Open any free screener and set 5 filters. 1. Market cap above $300 million, so you skip the tiny, illiquid names. 2. Return on equity above 15%, a quality floor. 3. Debt to equity below 1, so you avoid balance sheet time bombs. 4. A price to earnings ratio in a reasonable range, say under 20. 5. Positive free cash flow for the last 3 years, because real businesses generate cash. Run that, and 4,000 stocks might become 25. Now you have a weekend's worth of reading instead of a lifetime's. And here's the discipline part: don't tweak the filters until you get a name you already like. That's cheating. The whole point is to let the numbers surprise you. Adjust these numbers to fit your strategy over time. This is educational, not financial advice. Always do your own research before buying anything. But the framework holds no matter the market. Here's the one line I want you to remember. A screen doesn't tell you what to buy. It tells you where to look. The machine finds the candidates. You find the truth. Do the searching with software and save your brainpower for the thinking that actually makes you money. So which are you, a cheap-only screener or a quality-first screener? Tell me one or two in the comments. Tomorrow, I'm breaking down the single balance sheet number that exposes a dying company in 15 seconds. You won't want to miss it.